One of the things a lot of people want to know when they're looking at the VA loan process is what is the necessary credit scores and what does the underwriter look at? So for starters, credit scores are not a part of the VA loan guidelines. The lenders are responsible to set those, and individual lenders set them differently than others. I have 43 different VA lenders. Of those 43, a couple of them will go all the way down to a 500 score, and most of them will go down to a 620. The biggest thing when it comes to the VA pricing is 680 FICO is your golden. If you go above 680, you don't get a whole lot of benefit score-wise, and so some people want to get a perfect score, 800, whatever. That's not necessary. You're going to be fine as long as you get to 680. And then below that, you're still fine. You can still do the loan. It's just in 20-point bands below that, like 679 to 660, and then 20 points below that and 20 points below that. Every time you go lower than that, you're going to get hit with an adjustment on your rate that makes it a little bit more expensive. But you're still good, 620 and above. There's not a lot of difference between 620 and 680, but there is some. So pricing wise, as long as you're to a 680, you're golden. The biggest thing is if you get yourself to 620, then you're in the ballpark with everybody else. Then the second thing that underwriters look at is your capacity. So capacity is basically the 3 C's. You've got credit, which we were talking about scores. That's primarily what your credit is. There's also credit depth. How long have you had, how many accounts? If you're 19, you're not going to have credit scores that go back very far as your depth. If you're 60, then you should have stuff going back as far as they will report. You may have trade lines that go back 40 years if you're 60 years old. So you've got your credit, then you've got capacity. Capacity is where does the money come from and is it stable? How long has it been in existence, etc. So the most stable form of income is going to be your W-2 full-time salaried or full-time hourly, where that you're working at least 40 hours a week. When you get above and beyond that into overtime, that's going to be something that's variable, and the underwriter is going to want a 2-year guidance on that, or averages, etc. So the most stable form, again, is the W-2 full-time salary or hourly. When you get into variable income, they're going to want a 2-year average, and they want it to be a 2-year increasing average, not a you had a $1 million year last year and this year you're 100,000. They're going to want you to explain that, and they're not going to want to use the average of those two because it's coming down. So that's capacity, part of it. The other part of it is how much debts do you have monthly. So if you can make $10,000, but you can have $8,000 a month in bills, that's not going to be as helpful as the person that's got $10,000 in income a month and they have $1,000 a month bills. So you look at that on capacity wise. The VA loan does not do DTI, or debt to income ratio. It does residual income, but there's still a fairly good indication at 50% of your income. The last thing that people look at, or the underwriter is going to look at, is what is your stability in regards to assets, etc. So the collateral is what we use that last C for. What's the property worth? What's it appraised for? Involved in that to some extent is what kind of other assets do you have? That's going to be part of your character. Is this guy a saver, or is this lady a saver? If you're making $100,000 a year, you've got $1,000 a month in bills, and you don't have any money saved, then that's going to be a combination of character and stability, etc. Where's that other money go for? Where is it, etc. So those are the big things that we're looking at, is the C's, which would be character, capacity, collateral, and then credit basically is part of that same character. Hopefully that's helpful to you. The underwriter's not just looking at your FICO score, they're looking at the overall picture. One of the things that I will tell you on VA is that the VA guidelines are looking to approve you. They encourage the underwriter to make a positive decision, and they look at the whole picture. There may be that we have some compensating factors that enable them to be a little bit more aggressive. I've actually had examples where that I've done approvals at 80% DTI, and that's going to be a huge win for that person, because on any other loan product you couldn't go over 50. So hopefully that helps you, and let me know if you don't. I'd be very glad to help you. Giddy up.